I'm Gaurav Hinduja. I'm the co-founder of Axio. We were previously called Capital Flow, and last few months are now being called Axio.
Capital Float was one of the earliest lending fintech startups in India, starting out way back in 2013. And like any startup that has been around for a decade, they have gone through a fascinating journey that not only illustrates the evolution of the founders, but also the evolution of the tech ecosystem in India. In this episode of the Founder Thesis podcast, your host Akshay Dutt talks to Gaurav Hinduja, the founder of Capital Float that has now been rebranded as Axio. Axio is one of the most well-funded startups in the lending space, having raised about $200 million till date and is a market leader in the BNPL space, lending to millions of consumers. But the journey of reaching here has been full of many highs and lows, and Gaurav candidly shares his lessons from a decade of building and scaling India's pioneering lending fintech. Stay tuned and subscribe to the Founder Thesis podcast on any audio streaming app to learn business fundamentals directly from the veterans of the startup ecosystem.
I applied to business school and I went to Stanford, and that's where I met Shashank, who's my co-founder today.
And what's his background? Like before you guys?
Yeah, so he was before Stanford. He was at McKinsey in New York for about, I think, another 6 years or so, doing a lot of work in financial services, government, risk, etc. And so brought a lot of the global background, strategic background, and I brought a lot of the India-centric supply chain operations background. And so, towards the middle of second year of business school, we were pretty excited to come back to India. We said, hey, why don't we start a business? We didn't know what we were going to start. We just liked the fact that we were going to work with each other because we both brought different skill sets to the table. And so we said, let's go down this adventure and find a business to start. So a bit unconventional in that sense, compared to most entrepreneurs who actually face a problem and start a company around that problem. We were two entrepreneurs actually looking for a problem and spent a year after business school combing through about 20, 30 ideas before we landed on this.
So tell me that, that decision-making framework you used to finalize.
Yeah, that's an interesting one. So we had 3 points, and every business we evaluated had to have 3 points. If your co-founder is McKinsey consultant, everything is everything is very strategic, right? So, but we actually did a bunch of soul searching, and the 3 things that we came up with were, one, it had to be in India and it had to have some kind of impact in India, right? So that was where our hearts were. So anything like photo sharing, etc., was ruled out because we didn't feel that would have impact. Second, it had to have technology at its core, right? Need not be a hardcore tech business, but should be able to kind of leverage technology. Having spent time in the valley, you got access to a lot of those amazing companies there. You understood how tech companies can be built. And the third is it had to have scale, right? We were not looking to do a lifestyle business. Nothing wrong with lifestyle businesses, just that not what we wanted. And so we always had aspirations of at least, serving millions of customers or getting to $1 billion revenue or $1 billion valuations, everything that a typical startup entrepreneur thinks of these days. So these are the 3 kind of check boxes that every business idea we thought of had to fulfill. And we looked at 20, 30 ideas and, eliminated. Actually, we had to have a process of elimination with a business school professor of ours. And so there were some funny ones in there as well. We both love to eat. Like I said, we are South Indians. And so one of them was actually opening up a quick service idli dosa restaurant, right? But a franchise model, so you can do it on scale. But eliminated because we thought we'd be the only customers. We looked at preschools, we looked at apparel e-commerce because that was a little bit of my background.
Like Mintra Jabong.
Yes, exactly.
Okay.
It was just maybe a year or two after Mintra Jabong. We looked at, we looked at things like what Urban Camp does today, which is home services, etc. And financial services at fintech was always one amongst them because, at that point of time in the valley, there were the likes of the lending clubs, the Prospers, etc., who were starting to do some amazing stuff when it came to credit and lending. Both of us had no background in credit, but it was always one among them. And we came here and we said, okay, we finally narrowed down on that idea in 2014.
So you thought of this as a consumer play, like
no. Actually, wanted to solve credit. At that point, we weren't thinking consumer, SME, or etc. etc. We just said, let's start there. And as it happened, while we were doing that, a friend of mine who was running a small garment shop was looking to borrow money. And so he approached us and we gave him the first loan, and that's how we entered into SME financing. So it was a bit by chance. But then on, we spent a few years doing SME. We did consumer. We became multi-product. Till eventually we decided to focus and double down just on the consumer space.
So, let's like zoom into that journey. So, how did you, from idea to execution? Tell me that, like, did you, you wanted to do it tech first, right? So did you like build some sort of a online workflow for the loan process? And
it was for the first,
was it like tie-ups?
For the first year and a half, it was a Google form. That was the extent of tech that we had, right? So we would get, it was the two of us and another friend of a friend who joined us as a product manager. And it was the three of us that we literally started off as a Google form, having a borrower fill out like 30, 40 fields. And then we would go in the background and try to dig up as much information, read their balance sheets, read their P&Ls. And through some amount of guesswork, we would actually give the loan. And so
that loan from where? Like you were tied up with an NBFC or
no? So what we did is early 2014, we raised our first seed round, which was a $2 million round. It wasn't easy to raise back then, especially.
Yeah, I mean, 2 million is like a pretty big number for that. Right?
Yeah. And also more than a big number, it was, an industry that nobody's really looking at, lending, credit. We met a lot of VCs. And in fact, one of them even told us, you guys are from Stanford, you don't have the acumen, and putting that lightly, to be able to collect money in India, because it's a collections game. And at first we thought he's just talking nonsense, but over time we realized those were pearls of wisdom that he actually gave us on the ability to collect, etc. But anyways, we met a lot of VCs, finally convinced three, Sparta, Elevation, and family friends around as well. So we got the 2 million and started giving our first few loans. Most of that was on paper. There was no tech. It was us understanding the process. And about 6 months later, we actually bought our NBFC.
Okay. So like you were scouting around for some NBFC which had the license already.
Yes.
May not have been active, so that you can acquire and.
Yeah, that's exactly what we did. Actually, we found one CA in some back lanes of Kolkata who had 12 NBFCs with him. License.
Wow.
we picked one office cupboard and did as much diligence as we could on that to make sure everything was clean and everything was kosher and regulatory, and then applied to the RBI for a change and stuff like that. And so made it very clean and kosher. But it wasn't easy back then finding NBFCs, and seems like life has come a full circle now because everyone in fintech today wants an NBFC.
Yeah, right. Like, what is the process you use to find the NBFC? Like, I'm sure there wouldn't have been like some online platforms where you can.
No, definitely not. You have a lot of, brokers, advisors, where some of these consultants, sometimes the big four, etc., who are, sometimes help you out with this type of stuff.
Okay. So, 6 months down, you got your NBFC license. So now you're like a fully compliant lending business.
Yeah. And then we actually started to hire a few folks. We hired the first person we properly hired was our head of credit, right? Because we didn't know how to give credit. We were just like shooting off our hip at that point. But then we got in somebody who has done credit, who has given out loans. And then the next person we got was a very junior sales guy. And so then on, we actually, I think in 2014, all in all, we must have done maybe 6 loans, which was nothing. But that's really how we actually started. And yeah, those were the roots. We were 5 of us by the end of 2014. Only 6 customers, and I think maybe totally about 1 or 2 crores in terms of loans that we had given out.
Okay. And so you could just go year by year. So 2015, what was the story like?
Yeah. So 15, 16 was all about, tying up with e-commerce players because we didn't want to just source SMEs just through Google or through brokers, etc. So we wanted to have strategic tie-ups. So we tied up with the likes of Amazon, Flipkart, etc. Because these platforms, your Myntra, Jabong, these platforms were really growing at that point in time. And we realized that as they grow, the sellers of these platforms would need working capital to keep up with the growth of the e-commerce platforms. Right. And so we started working with them, saying, hey, why don't we finance your sellers? And that's really how we actually kind of started the business, financing a lot of the sellers on these e-commerce platforms. I don't remember the numbers we did back then, but we went from, I think, 2 years from about 1 crore in loans to, I think, at least about 30, 40 crores. With also kind of bad debts very, very low at that point in time.
So these Amazon, Flipkart sellers, you were doing that bill discounting, like if they have to receive, let's say, 1 lakh from Amazon for products sold, you would give them.
It was not exactly. It was not exactly that. We were kind of giving longer term loans. We were assessing, how active have these guys been on Amazon, Flipkart. What are the last 6 months saying that they sold? Let's say in 6 months they've sold, let's say 20 lakhs. We felt that in the next 6 months with the season, etc., coming, these guys could sell another 50 lakhs. So we would actually give them a loan of 15, 20, 30 lakhs. And then actually it was pretty unique. We tied up with Amazon, Flipkart to create an escrow mechanism where whatever money this person sold on their platform would be routed through us as a repayment. So we would take out what the borrower owed us and pass the balance back.
Okay. So whatever is the monthly installment that would get paid off first,
exactly,
and then the merchant gets, or the seller gets paid. Oh, amazing! How did you crack these deals with Amazon and Flipkart? Like that, there's like a pretty major unlock for you, right?
Yeah. In fact, that unlock on Amazon has led to a lot of good things in our journey, and I'll talk about that, right? Well, it was actually funny. It was a business school senior of ours who was running seller services at Amazon. And that's how the conversation started. And it was just, as luck would have it, sometimes you have a friend in the right places, and they were also looking for something to supercharge their business and start. I was just aligned, I guess. And once you started working with Amazon, then everybody wants to work with you.
What did this lead to, this Amazon unlock, like you said?
Yeah, so ultimately, as we did, for spend maybe 2-3 years doing Amazon and all the others, but ultimately what happened, they grew a lot of this business, but then it was around, I would say 2019, when this business was growing. It was good. It was an interesting business, but it was in 2019 that, having worked 4 years with Amazon, they were like, hey, we want to provide credit on the consumer side. And since you guys already know us, let us, start a joint program on the consumer side where we will co-develop the product with you guys. It will be of massive scale. We will give you mutual exclusivity. So you work only with us on e-commerce and we'll work only with you on the lending side. And also we would take an equity stake in your company. And that really began in some ways our evolution and journey into the consumer credit side of the world.
Wow. Okay. So, like before this, by 2019, what was your loan book?
Yeah. 2019 was a fun year. It just for, I think it was October 2019 when the ILFS crisis happened. And at that point, our loan book was at peak. We had about 1,200 crores. So we had gone from like 50 crores in 2015 or 16 to 1,200 crores in 2019. And I'll never forget that day, October 2nd. Actually, I was on holiday when the ILFS crisis happened. And it was there that I felt that our world came crashing down. Because that led, one crisis after another for the next 3 years. Because we had just come out of DeMon and GST, which had impacted us, but not that bad. So there was some defaults, etc. in the book, nothing crazy. It was about 4-5%. But when the ILFS crisis happened and we were not a profitable company back then, there was a flight to quality, and suddenly overnight, a lot of our debt clients got opened for no fault of our own because there was fraud at ILFS and the larger NBFC kind of macro. And that was a very interesting, 2019 was a very interesting, challenging year for us. We had to really relook at the business. We had to obviously take some hard decisions in terms of cutting costs, laying off people. We did all that hard work, brought down our burn by almost 50% from, I think, in a span of 8, 9 months. And the business was starting to look good again. And beyond March 20, we entered into COVID.
So good.
And as you know, COVID was a fun couple of years for everyone, but particularly in lending, because in March, end of March, early April, the RBI governor actually said that, if you're an NBFC, all your borrowers are allowed to not repay you, but guess what? You have to repay the banks. You have to repay the banks. And
right. Yeah. That loan moratorium was only for retail.
Yeah, it was one side. Right? So we were stuck. We were like, if this continues for another 3 months, we'll run out of cash. It doesn't make sense. But somehow, I literally, by the grace of God and luck, we survived that period. It was hard. It was tough. We had some management changes. People doubted us. There was a lot of bad PR about us. And all this while, just before COVID, during the IL&FS crisis also, there was a company that was about to acquire us that fell through at the last minute. And so all this happened, but finally we got out of it. And, the reason we were able to get out is because our buy now, pay later product, which had started with Amazon a couple of years ago, really started to take off as COVID hit. And so as we entered COVID in March 20, we had maybe about 300,000 customers. And as by the end of wave 2 of this COVID,
300,000 is, you talking of the B2C customers, not the...
It was both. It was SME, B2C, everything put together. But by the end of wave 2, which was in January or Feb of COVID, we were at 3 million customers, or 2.5 million customers, right? So that 1 year of great growth. And we were like, okay, it's time to change the business and time to double down and focus on this product that's really growing for us.
Okay. So from 200 crore, you went to 1200 crore. How are you funding this? Was it through debt?
This was through,
you raised more money?
So this was through a combination of equity and debt. We had raised money from Sequoia, Remit, Creations, raised close to about 100 odd million in terms of equity, but also much more in terms of debt as well. And we started building the first platform of its kind called co-lending, where we actually would have other banks and NBFCs co-lend along with us. This was maybe 2018 or so.
Okay. So your source of money was 3 essentially then. One is equity. Second is you borrow from a bank directly so maybe you would borrow at 10% and you would lend out at 20%, something like that.
I wish it was 10%. It was more like 13. It was like 14. But you got the principle was correct. And then the third was the co-lending. And we had
where you would lend half of the amount and half of the amount would be
from the bank,
another NBFC or a bank.
And we had a fourth source, which was we had actually developed a good base of about 200 family offices and HNIs who would actually consistently give us debt. And that source ended up being the most stickiest capital for us during our tough times during COVID. They never let us down. And, we are very proud of that base. And even that base till today is really growing with us.
Okay. So this would be like a traditional businessman who wants slightly better returns than market. Yeah. But at the same time, not like doesn't want to take crazy bets on exactly doing angel investments and all.
And in the I'm a Sindhi, like I said, in the Sindhi, Gujarati, Marwadi community, you have a lot of the communal offline money lenders. So a lot of them were looking to deploy capital as well. So we would, like you said, give them good returns with good yield without crazy risk. So we tapped a lot of those sources.
You would pay them similar, like 14, 15%?
Slightly higher, slightly 15, 16%.
Okay. And on an average, what was your interest that you were earning?
We were lending at roughly about 21, 22. Which as we realized, it took time to realize it was not enough. The spread was not enough, accounting for costs, NPAs, etc. Because I think we were not from the industry, and this sounds like apple pie and motherhood statement. It took us a while to really realize what the true unit economics of lending are. Because in lending, you realize on your mistake only 1.5 years later when default actually happens.
Right. Okay. what are the unit economics of lending? Like what should a healthy lending business have as its unit economics, like based on your learning?
Yeah, so you should at least have, you should be able to have a spread here. That means your cost of borrowing minus your cost of capital should at least be 10 to 12. So if you're lending at let's say 22, you should not be borrowing at more than 12, which is where we are today. So let's say you got 10 there, right? You've got, let's say, an NPA of 2%. So you should, anything in the 2 to 3, you're okay. Beyond 2 to 3, right, you're in trouble. So that 10 minus 3 becomes, let's say, 7. 7, then your OPEX should probably be around 3 or 4, which that finally gives you a 4% kind of ROA, right? We're not there yet as a company, but that's typically where mature businesses operate at.
Okay. Got it. Okay. So, why were you, like you said, by 2019, you were not profitable yet. Now, my understanding is, again, not as a lending industry insider, but typically reason why startups are not profitable is because they have to do cash burn to acquire customers. But in your case, you didn't really need to do that, right?
No, we were doing it in a different manner, right? We were giving loans cheaper than expected to grow the book. So we were giving loans. So if a borrower deserved the 22% for their risk, we were giving loans at 18%. So it wasn't a cashback of sorts. It was, I would say, to some extent mispriced because we thought that at 18% you'll manage to a 2% NPA, but it ended up being a 4 or 5% NPA, right? Which is not bad if your yield is 23, but at 18 it doesn't work, right? So for 2-3 years we built the book that way, and then obviously COVID and stuff like that.
Okay. And how did you fix NPAs? Which is also another way of asking, how did you fix collections? Because you were not from the industry and you told me that VC gave you advice that you don't know how to collect money.
Yeah, that's an interesting story. And I can tell you that today we probably have the best collections team in-house. So it was, around the same time, 2019-20, we really started to deep dive into collections. While Rich is,
till 2019, how were you collecting?
We had a kind of small collections team, but we would outsource a lot of it, right?
Okay.
To be honest, we were not spending as founders and as management team. We were not spending as much time on it as we should have spent. Right?
Your energies were more on growing the loan book.
Stuff like that, right? Typical mistakes that anyone would make. But post-COVID, or since the start of COVID, till today, I probably spend at least 40-50% of my time on collections because what we've realized is 50% of a fintech lending business is all the tech and the sexiness. 50% is collections. This is your to do that, right? There's no other way out of it. So what we've actually built over the last 2-3 years is 2-3 things on collections. One, a complete in-house tech stack that can automate collections. It can monitor communications between a connector when a person is speaking on the phone or going feet on street, and app our feet on street collections used to make sure that we know where exactly he's going. There's a smart algorithm in the background that predicts what is the right collection strategy for each borrower. So Axio may require a phone call, I may require a feet on street visit, somebody may require just an SMS, right? And then the fourth is it's linked into our loan management system in real time. So you can make a payment today, UPI, cash, check, etc. It kind of hits our account in real time. Right? And there's a whole dashboard that I look at on a daily basis that every manager, collections manager also looks at, right? So it's like a one-click setup that has all this infra of the background that has really helped kind of change who we are as a collections entity. Over and above that, what we decided was, say, took everything in-house. We found anything you outsource doesn't work, right? So we built it up as a core strength, as a core muscle, and actually took all the resources in-house. So we have callers, we have feet on street, and we don't shy away from collections. It is a collections business. You can do all the amazing stuff in risk and underwriting and evaluating borrowers. At the end of the day, you have to follow up on a call or sometimes the feet on street visit. And that's the only way. So it took 3 years of hard work to kind of manage collections as we changed the business from SME to consumer as well. And since I would say maybe wave 1 of COVID or wave 2 of COVID, our NPAs have been sub 2%.
And so you tell me about that acquisition which was about to happen. Like, was it a e-commerce company wanting to acquire or another fintech company?
It was a large payment company, payment gateway company. I mean, you can guess.
Oh,
Whatever.
okay.
That
Right. For
that has
payment.
that has recently put a news for the taking or another deal as well. So, uh, they were a payment gateway. They wanted a lender who could obviously add value, and
Right.
by kind of lending to their customers and their merchants. And it was a large deal. And then honestly fell apart in 11th hour as we were ready to sign the documents, maybe a day or two.
It was a couple of $100 million, like the sale price.
Much north of that. And then we had to rebuild.
What happened? Like, why didn't
I still don't know. When I find out that
Okay.
I honestly, I wish we did a lot of soul searching, Shashank, and to find out what happened. I don't have a good enough answer that I can actually give you.
Okay, but it caused like distraction. You would have taken your eye off.
Yeah, it caused more than distraction. It caused a lot of issues because this was the time of ILFS, right? And keep momentum in a deal like that. We actually grew the book during the worst macro for NBFC. So probably all the worst or most stupid decisions we should not have taken during a recessionary macro for the NBFC world, we ended up taking to make sure the acquisition went through. And that came to bite us badly over the next 2 years.
What were those stupid decisions and why were they stupid? Like, help me understand the why also.
Yeah, sure. So the why, when you're tight on capital because of the ILFS crisis, the one thing you do is you hunker down, you control NPAs, you don't look at growth, you forget about growth. But when there is someone who is in the process of acquiring you, you cannot show any growth.
If you have money in the bank, then why not lend it out? Like, why keep the money idle?
We didn't have that much, right? Because we had to keep a lot of our deadlines got pulled. So normally we like to keep enough buffer stock and all. We started eating to our buffer stocks, right? And our deadlines were not keeping pace because of the ILFS crisis. So we came pretty close to the break to show growth, all for the sake of growth, which we needed to show just for the acquisition. Otherwise, there was no good reason to show growth at that point in time.
So for a lending company, it's not like they have money in the bank, but they have deadlines, which like title them to money in the bank. And you constantly need buffer.
Yeah, we need to borrow so we can lend out, right?
Right. And you also need enough excess money for like meeting day-to-day expenses, payroll, etc. In case you're not able to get enough collections in that month, then
exactly. And so we got over all that the year of 2019 and started to turn around the business. And March 20 was when COVID hit. So hunkered down for another interesting 1 year period.
So once COVID hit, like, did you stop lending or like what was because
so we stopped a bunch of the stuff, but we did not stop our buy now pay later product with Amazon. That continued because those were small ticket loans, and we felt that we got enough capital for that. They were like our buy now pay later all 5,000-10,000 rupee loans, and we saw that was growing, and we needed to keep some green shoots going in the business. So we continued that while we put a stop on most other things.
And buy now pay later gives you a better rate of interest. Like your spread is better with BNPL.
It is okay, but the main reason for doing buy now pay later is because you acquire customers and then you ultimately cross sell them other financial products. So it's a customer acquisition engine for us. And over the last year and a half, we started cross selling a lot of those customers personal loans and other types of loans, which are very, very profitable. And honestly, this is what Bajaj Finance has done for the last 20 years, where they give you checkout finance at a store when you go to Croma, and then they cross-sell your personal loan. They've executed wonderfully over 2 decades. In some ways, we are the online version of that model.
Okay, interesting. So in BNPL, typically the consumer doesn't bear the interest cost, right? The seller is...
It's either the merchant, it's mostly the merchant that bears. It's interest free for the customer.
Which is called subvention in the insider language.
Okay. You know a lot of the insider language.
Okay, got it. So what is, like, give me an example of like what a typical BNPL customer would yield to you as a lifetime value. Like how many transactions would he do?
So I'll just explain to you how it works first. So when you're shopping, let's say on Amazon, you go there, you're checking out, you're buying, let's say, I don't know, headphones or something like that for 5,000, 10,000 rupees. You typically are a customer who we target, they don't have credit cards, right? So your only option is to kind of pay via debit card. But at that point, while you're shopping, we actually give you the option to get credit. And in real time, within 3 seconds, we actually underwrite you, right? So we pull out whatever data that we can get from our models, from the bureau, etc., etc. And in under 3 seconds, we do your KYC. So we are very regulatory compliant. And we tell you, hey, okay, you've got a loan of whatever, 10,000 rupees, how you can continue your shopping here. So that's really, so what the tech that we've been able to build, the underwriting muscle, and then ultimately the collection strength is really what's the, the USP of the business that we actually built. Yeah. So the customers today are, using us almost 5 to 6 times a month. Average customer cohorts end up at, let's say, 100 transactions in about 12 to 18 months. And they're still going. Right? So finally figure out how to ensure that lending is not a tradable business. You don't always have to keep originating new loans. Then, like I said, we take a small cohort of those customers, about 5 to 8% of them, and we cross-sell them a larger ticket personal loan, which is where we end up making a lot of money.
Okay. So most of your customers would be using like 5-10,000 rupee or something like sub 20,000 rupee multiple times in a month.
Yeah.
So,
And the reason we've chosen that path, of that smaller ticket size is actually a very conscious strategy of low and grow, because we are actually targeting customers who don't have credit cards. 70% of our customers don't have credit cards today. As you know, there are about 120, 130 million online shoppers. There are only 30 million unique credit cards in the country. So we are really going up with 100 million who don't have those cards. That's why we're starting them off at 5-10,000 rupees. And then 3 months later, we give them slightly higher, 6 months later, slightly higher as we see their performance.
okay. And is this like a convert to EMI or is it like pay in 14 days? Like there are two types of
we
BNPL.
don't do any 14-day stuff. Because the minimum is 1 month, maximum can be installments are going up to 12 months.
And the entire amount is borne by the merchant. Like if someone is doing 12 months.
Yeah, the interest is borne by the merchant. In about 80-90% of the cases, 10-20% of the cases, the customer bears the interest.
Depending on the duration, I guess. Like for short term.
Yeah, exactly. Depending on duration, depending upon product also, right? So for example, one of our largest merchants today is Policy Bazaar, where we finance the premiums for health insurance, right? In that case, it's a longer tenure loan, 9 to 12 months, and the entire insurance, the premium, or rather the subvention is borne by the merchant, right? Whereas in the case of, let's say, an airline ticket or Make My Trip, OTAs don't have that kind of margin. So they don't, so there's customer pay, right? So it varies by tenure, by product.
Okay. So like you started with Amazon. So you like built up this 3-second approval mechanism and all that.
Sure.
What is the underwriting strategy that you follow? Like, is it based on the CIBIL score? Or?
So that's one part of it. But even on the CIBIL score, we look at the data, not just the score, and we build our own score based on the data we see at the bureau. The second is we have our own app that kind of has looked at a lot of personal finance management apps. So we help kind of people track budget, make expenses, etc., based on the SMSs that we see with consent, obviously. And then through that, we built a predictor of income. So we're able to predict to a pretty high degree what your income is.
Yeah, because every time money hits your account, you will get an SMS alert.
Exactly. Right. And third is in some cases, with some merchants, we also kind of get to understand or we pre-filter with them, what is the behavior on the e-commerce platform. So for example, if you just signed up on Amazon or Make My Trip yesterday, you'll most likely not see this offer. Right? We like to make sure customers have had some vintage on the platform. They have not displayed any fraud tendency. So there's like a qualification criteria there as well.
Mm-hmm. Like somebody who is frequently returning products that might be indicator of fraud.
Yeah.
So they would not see that option.
Yeah.
Okay. So your own app, you may not be getting data for that from somebody who's buying on Amazon.
No, it's a lookalike model, right? So we've had 10-12 million downloads. You're right. It's not the same people who are coming on Amazon or Make My Trip or whatever. But based on the data that we have and based on the incoming customer, let's say on any of these platforms, and looking at the behind the scenes bureau scores of both these segments of customers, we're able to build a lookalike model that has high predictive power. So it's not the exact person, not the exact income, but it's a lookalike model.
Can you explain this through some example? Like say someone from Bangalore with a credit score of 750. So you would build a
let's say
like that?
So let's say someone from Bangalore who has, let's say we have seen 20 SMSs, but we also know he shopped on Amazon, has a score of 750, has a credit, and let's say has a two-wheeler loan. We are able to, or let's say has a housing loan, we are able to triangulate that their monthly income is, let's say 30,000, 40,000 rupees. Through the bureau, we also know what their debt obligations are because they have EMI on the housing loan. So then we come up with what is a net disposable income. So we know that, okay, this person, after all their salary and obligations, has a free cash flow of about 20,000. So our line should typically not be more than 25% of their free cash flow. So for that person, we'll give a 5,000 rupee line. It's a much more simplified version than what actually happens. Typically, that's how we look at it.
But how does this convert into lookalike?
That's more.
So this is for somebody who has the app, but for somebody who's not on the app and comes to
we
Africa.
do a lot of pre-filtering exercises, right? So we've developed joint scores and stuff like that with our e-commerce partner that can predict some of this.
So the app data is essentially training your algorithms
Yes.
to make better decisions.
Yes.
And those algorithms are then applied to e-commerce customers whose data you may not have, but
there's a
because
score,
of the training.
But there's a score there.
And so there would be like multiple scores which would get
Come together
into consideration.
Yeah.
Like an e-commerce score, like on Amazon, how is
There's an e-commerce score, there's a bureau score, there's an income score, there's a fraud score. So all these four come together and then we kind of give the person a loan. And all this happens in 3 seconds.
How do you generate an income score in 3 seconds? Like, wouldn't you typically ask for bank statement or something?
No. See, because you're giving 10,000 rupees, right? So, and it's while checkout on e-commerce, so you can't really ask the person for a bank statement, etc. There's too much friction in that. When we give the person the longer ticket personal loan, at that point we ask for a bank statement for people who take it. Here, this is, like I said, this is based on this inside models with a high degree of confidence. That's all.
Okay. Amazing. Okay. Got it. Okay. And so this must have evolved significantly from your original credit model, right? When you were lending to merchants.
Yeah.
What was the model at that time? Like,
so that,
tell me that evolution.
Yeah, that actually they were lending to merchants had a decent amount of manual intervention also, right? So we would collect the data and the pipes were digital, how we would get the data. But there was manual intervention in where there would be a credit manager who would look at the case in detail. Because then on the merchant side, the loans were like 15 lakhs, 20 lakhs, right? So you couldn't give it so fast. And there was no need to give it so fast. You want to do a little more diligence. And so there it was a little more manual. There were models, but it was always verified by a human being, right? And so the problem there was you didn't have enough loans to train your models, right? Whereas now on the consumer side, in the last 3 years, we've done, I think, close to 30 million, 40 million loans. So in every loan, there's repayment data, and that kind of really helps you build the model.
Okay. So that lending to e-commerce merchants is like a easy to get in business, but hard to scale business. Like it's easy to start doing it because they want money. You get with one tie-up, get a lot of business, but it's hard to scale it up. Plus, I think at one point of time, there were a lot of companies which were operating in this space. I think it also became pretty competitive, right? Especially bill discounting for e-commerce.
The banks, because I would say we were not that high on the tech cost, right? Because of the larger ticket sizes, the banks got it. And you can't beat the bank's cost of capital, right? No matter how efficient you are in terms of customer experience, a lower price always the best customer experience. Banks got it, even though they would take like 2 weeks to give an SME a loan, whereas we would take 2 days. The SME would wait for like 400 goods, 500 goods lower.
Right. Okay. And that's the reason why you were not profitable also, because that space was very competitive.
Exactly.
You didn't have a moat over there as such.
And I said, and if I now look at the consumer business, the moat is very clearly 3 things, right? One is the acquisition channels that we have, deep pipes tech into a lot of the large e-commerce players, which I don't think any bank can build. Or maybe they can. I don't want to say they can't, but it's pretty hard, right? Because folks like Amazon are holding to very high service level agreements. So 99% success rates during this Diwali, like we were seeing 400 transactions a second. And if you don't meet those standards, right, then you're going to upset the quarter. So the second mode is now become connections and NPS, which I think banks obviously are good at, but they may not be necessarily good at the smaller ticket side stuff, managing collections.
You said 3 modes. Second is collections.
So the third is kind of just, customer experience and making sure there's a good kind of CX that you can do that.
For the app is a part of customer experience. Like when someone takes a loan, then they download the app to see what is the repayment date.
So they can, but they can also see it on the partner dashboard, right? You can see it on the Amazon dashboard or the Make Merchant dashboard. But about 30%, 40% typically end up downloading the app, where they can obviously see all the loan details, but they can also see personal finance management, right? They can kind of use it for managing budgeting, etc.
Like the app downloads have been driven by which factor? Like, is it people like you spent money to market the app as a personal finance app and hence?
Yeah, it's mostly personal finance management. And just very recently, we've added the whole credit piece into that. And so that's a big area of focus for us this year, where we'll probably be the only app that gives you personal finance management, but also gives you credit.
And what is the app called?
It's called Axio now. It used to be called Wonder.
Okay.
But now it's called Axio.
Okay. And essentially, is you use it for budgeting, for figuring out your expenses, breakup of expenses.
Exactly.
Okay. And do you also have like investing and savings?
Not yet, but that's coming soon.
Okay. Like you'll build that in-house or you'll collaborate with the fintech?
I think we'll build the UX layers and stuff like that, but the underlying manufacturing of the products will work with somebody else.
Right. Yeah, because they're already very large investment.
We don't need to.
We
don't need to build the entire thing. For us, though, credit is always going to be our core product. And then everything else we offer is just around making sure we engage the customers and can obviously make money. But credit is always going to be our entry point.
So what are the players you integrated with? Like you said, that's one of your modes, your integrations.
We've got about 3,000 odd merchants, but some of the larger ones are obviously Amazon, Make My Trip, Policy Bazaar, a big one with Razorpay and all their merchants. A lot of D2C brands, healthcare, edtech. So 7-8 categories at 3,000 merchants, and obviously that keeps growing.
Okay. So for a payment gateway, it makes sense to have a lending play because checkout finance is seamless for them.
Exactly. They see higher AOVs, they see better margins.
Average order value, AOV. And what do you mean by that? That they see higher AOV?
So typically, let's say a person is checking out on a D2C brand, right? And they're buying headphones for 2,000 rupees without credit. But there is a credit option. They would typically buy something slightly higher for 3,000, 4,000.
Okay.
And
and payment gateway companies earn by the size of transaction, percentage of that. Yeah. So it makes sense for them. Okay. Amazing. And your connection strategy also must have changed when you pivoted from SME to consumer.
Sure.
Like, do you still use feet on street? Because for consumer, feet on street is not scalable, right?
No, we use it very sparingly for, later buckets. So let me give you an example, right? All our loans are due on the 5th of the month, right? That's called the due date. So typically about on the due date, 15% of the people don't pay. That's our bounce. And then the next 30 days, about 91 to 92% of those 15 people end up paying through telecollections, right? That is the first bucket.
Telecollection, SMS, email,
all the digital tele, all of that stuff, right? That is the first bucket, as we kind of call it in collections. That's where the battle is won or lost. So only 10% of that 15%, so 1.5% on them, they go into the subsequent buckets. Now, for some of those people, if it is a larger ticket size, if they're in a larger city, you'll use feet on street. Otherwise, there's about 50-60% telecalling, etc. Right? So you're right. The feet on street is much less, but we still think it's an important component.
Okay. what is the impact for a consumer when they miss paying on due date? Does the credit score go down immediately, or is there a grace period? Or?
Yeah, so typically after 30 days, the credit score rate starts to go down if they're not paid back for 30 days. But we obviously allow customers the grace period of 3 days. We don't charge them a late fee and all of that stuff if they are within the grace period. But beyond that, there is a late fee that bureau score does get impacted. And then we don't follow up with the customer, right? I mean, you've taken credit, now you have to pay it back. There are no free lunches.
Okay. So like if 5th of April is due date, by 8th you pay, it's okay.
Yeah.
You don't lose your credit rating and all.
Yeah.
But beyond that, then you get charged a late fees, your credit rating goes down and so on. Okay. Got it. And this, like the collection mechanism must be all online. Like they could just do a UPI or whatever.
Anything they want, right? It's mostly 95% is all digital. So UPI, NEFT, stuff like that. I think less than 5%, some people want to pay cash or something, so we don't say no.
Okay. Are you also exploring embedded finance? Like, say there is a investment app and you, like, for example, Cred has some peer-to-peer lending collaboration with, I think, Lending Club or some such. So, like that, like say ET Money could be an app where you could plug in lending for that app, like that kind of
that's in some ways BNPL is the father of embedded finance, right? I mean, you're plugging it into platform. I think for now we're going to stay focused on the BNPL side and build the customer journey, but that's something we could definitely look at because it's a similar skill set that we've actually developed, right?
Okay. Let's talk about the organization. So what is your headcount now? And what did you learn about org building, culture building? Can you share some of your lessons over there?
Yeah. So the org is probably about 500, 600 people today. In terms of, org building, there are two, three things that we learned. One is in this type of business, you want both types of people, from finance background as well as from tech background, right? Because you need the tech folks, the product folks to keep pushing you forward in terms of customer experience. We're obsessed about that. But you want the traditional fin folks because this is lending and you can lose your shirt very quickly, right? So we try to maintain that balance at all levels within the org. So that little bit of that creative tension does exist always between the fin and the tech teams. The second thing is, we believe always in kind of homegrown in-house talent. So I would say about almost 50 to 60% of our top 80 people in the company have crossed 5 years. In our senior team, again, which is about 10 people, barring one or two, almost everyone's been around for 6-7 years. Our CFO and our chief product officer joined us 7 years ago as junior folks and have risen through the ranks and now part of the management team, right? So we love and like to encourage folks who kind of been with us through thick and thin, have obviously kind of displayed the fact that they can do it. And ultimately, we just like kind of a no-nonsense kind of attitude. And we have made mistakes, obviously, when it comes to the people side. We get a lot of hiring mistakes. Sometimes you like to take people from large, well-established organizations who are rock stars there. But you end up typically realizing that they were rock stars because of the processes set at those organizations and not necessarily because of their own ability. So once you bring them to a younger, more agile startup, they feel like a fish out of water, right? So I think, we made a bunch of those mistakes and I think we're better for it, right? We've learned those. And so I think the one thing now is between Shashank and me, we obviously kind of divvy up what we both are good at. But we've got a core team that hopefully kind of has been around for long, has been around through the tough times, and it's only onwards and upwards from here.
Okay. 500 is a pretty lean size. What's your loan book at today?
It's almost now back to 1,200 crores. So we had got down to from 1,200 back to about 200 and built it back up.
Okay. And I guess 500 will be pretty lean by industry standards, right? For a 1,200 crore loan book.
Yes and no, because we do have a lot of folks from, we don't have very few sales folks. We have a decent amount of collections. We have a decent number of tech and product who, as you know, are probably not the cheapest resources in the country today. Right? So they're super great, talented people, but obviously uh, come at good prices, right? So yeah, then we have a few outsourced folks as well for like callers and customer service and stuff over and above.
Okay. So, who are your competitors in this space? Like others,
Yeah,
you would be seeing BNPL companies as your competitors,
yeah,
right?
and you
Like,
have, obviously you've got a lot of competitors who we respect in this space, right? You've got folks like Zest Money, Lazy Pay, Early Salary, etc., who are again well established, well regulated companies. As we venture into the offline world, which we will do soon, and we're starting to experiment, you will come across the big giants of the Bajajes of the world.
how are you edging into offline? What's the plan there?
Through partnerships with payment gateways, POS players, etc. So we will never put a person in the store. We will work with aggregators like a GoPay, a Pine Labs, a Razorpay, etc. to penetrate this.
Okay. So, like, at the time the shopkeeper is swiping, the shopkeeper will get that option and he can offer it to his consumer to increase his average order value.
Exactly.
Okay. Got it. Okay. And what about getting into credit cards? Because you are in a way doing that, right? Like when you give someone a 5,000 approval limit, it's like a
So that's on the cards. We were always apprehensive because of the regulatory structures of NBFCs doing credit cards. Some people took options that obviously now the RBI has said it's not kosher. So we are working through the right regulatory structures, and that's definitely something on the card that we will.
okay. Like only a bank can issue a credit card as per
only a
norms.
Yeah. So the only way to do it now is through a co-branded with a bank, etc. So those are options we working on.
And like there was some major change in regulations because of which a lot of fintechs got affected. What was that? Like where you could not offer
a lot of
credit or prepaid
a lot of fintechs were using a PPI card, which is a prepaid instrument, and miming it to be a credit card, which obviously the RBI didn't like. Some could say it's a gray area, some could say it's illegal. I won't opine on that, but RBI clearly didn't like it, and so they've shut that down.
So a prepaid instrument is like a debit card, like something which reflects your actual balance in some.
So the
sort of a
credit now was funding that prepaid instrument at the background through credit.
So like as soon as you want to spend, you can load it up with money, which is a loan basically.
Yeah. So not the intended use that the RBI had come up for prepaid cards with. So it's kind of been shut down, but I'm sure people will evolve and find new models.
What about the UPI apps? Do you see them as competition like Paytm is big time?
I think Paytm definitely is a competition. I think, however, obviously, as much as we respect them, I think Paytm is always going to be in some ways closed loop, right? They will serve within their ecosystem. Typically, players outside the Paytm ecosystem will not want to work with Paytm, right? So, which is why we are a bit kind of more open stack in that sense. We will work with all the players, right? In Amazon, Waymo, Tata, etc., right? And so in that sense, hopefully we become the arms dealer to a bunch of large platforms.
Amazing. Okay. And where do you see yourself like 5 years down the line?
Yeah, so we are today at 6 million customers. We are hoping to close this financial year closer to 10 million. We're adding almost, 400,000 customers a month. I think in the next, I would say 3 to 4 years, the goal is to get to about 25 million customers. We are now financing almost about 450 crores a month. Again, goal is by March to get that to about 600, and in the next 3 years, get that to about 2 or 3,000. Finally, I think, build a good profitable business, and in about 3 years, go public. Because, the markets for financial services in India have always been good. If you can build a good track record, a good business, there's always a good opportunity to kind of hit the public markets and control your own destiny.
And you want to be pure consumer play, like that SME lending is something you've completely stopped.
Yeah, I think we'll be, we've gone from being a multi-product company to a single product, but with a focus on the consumer journey and how they start with us and how we build it through their lives, right? Now, as the customers evolve with us, we may add in more products, but the focus is always going to be on serving those customers, those 20, 30 million customers that we will always have.
You had all of those like near-death experiences of island affairs and COVID. How did you feel during those times when it looked like it was the darkest kind of a...
Yeah, there are a few things that you rely on. Obviously, the good stuff is family, your co-founder, your colleagues at work, etc., who make you go through those phases. But I always felt that I needed something outside, and I've always been a very competitive person who loves sports a lot. So around the early days of COVID is when I started picking up triathlons. So I do 2 Ironman triathlons a year, and I train a lot for that. So I train about to 12 hours of week, and being able to do an Ironman triathlon and be disciplined, make sure you finish that race, which is a very, very hard race to do, actually has helped me focus on work. Because in work, obviously, there's always ups and downs. Even today, we have a lot of downs, we have a lot of ups, but it kind of makes you show up at office every day. That discipline makes you kind of make sure you never give up, because you can't give up in the middle of a race. And so in some ways, you've learned to kind of equate the race of the Ironman journey to the race of running a startup. And that's actually helps a lot. And the only advice, if I could give fellow entrepreneurs, is find that something outside work that kind of keeps your juices going.
Amazing. Like you have raised almost, I think, $200 million by now. 150. Okay. And so, what are your lessons on fundraise and that you'd like to advise to young aspiring entrepreneurs?
Take less early on. We made a mistake of our Series A taking too much.
How much did you take it?
I think we had taken about 13 million, which was on a 25 or 30 million pre-money. So it was almost like a 30% dilution, which there was no need. You can never recover from that in later rounds, no matter how low you keep your dilution, right? I think that was a mistake. We should have, I think in your zeal of kind of, trying to go one-upmanship on other startups and take more money and get into the headlines, you end up doing things that you shouldn't do it. My only just take the amount of money that you need, not more, and then build the business accordingly. Again, apple pie motherhood statement, but sometimes out of excitement, people tend to really forget that. And the second thing is, you are going to hear a lot of no's, so be ready for that and just have conviction on yourself.
What's the no to one ratio at like seed stage? Because that's the toughest, right? Like
actually, that was not the toughest for us. The toughest one was for us that we did last year. We're just coming out of COVID, coming out of our problems, coming out of the that we had done. I think that was maybe a 50 no's to 1 yes.
Wow. And this is in a market where the universe itself would be like maybe 100, 200.
Yeah, and 2021 was like a great year for most startups, right? But we had our challenges that time, but we have got faster and now we're back up again.
Okay. And I think you raised about $50 million, right? That's like the round we did last year.
That's right.
Wow, that's amazing. Okay. Cool. And that brings us to the end of this conversation. I want to ask you for a favor now. Did you like listening to this show? I'd love to hear your feedback about it. Do you have your own startup ideas? I'd love to hear them. Do you have questions for any of the guests that you heard about in this show? I'd love to get your questions and pass them on to the guests. Write to me at ad@thepodium.in. That's ad@thepodium.in.